All right, everybody, it is Tuesday, March 31st. Was this like the 738th day with the mask? And again, I'm doing this for posterity. We're going to look back at this at some point, hopefully soon, and remember this ordeal. I am coming to you from the epicenter, and now it's just, the numbers are crazy. I am in New York City. I believe we have now 70 or 75,000 cases in New York City. Over 1,000 dead. Yesterday I talked about they were setting up field hospitals in Central Park. We had the U.S. Navy hospital ship come into the harbor. It is, like I said yesterday, it's surreal. And it is apocalyptic what is going on here. All right, we'll talk a little bit about the markets. Two things. I want to talk about gold, and I want to talk about some new Fed operations that were announced today. First, let's talk about gold. Yesterday, an interesting announcement, which I picked up. Luckily, I saw it pretty much the instant it came out, and I sent out a notice to my subscribers. The Russian central bank has ended its purchases of gold. Now, this is important because over the last 3 years, maybe even longer than that, the Russians have been the largest gold buyers in the world. Official purchases by the Bank of Russia of gold were the largest of any central bank in the world. And this was a factor in my bullish outlook on gold. There are other factors as well. Of course, the monetary policy. I can go back starting from December 2015 when the Fed started raising rates. I've been all through that. I won't go over that again. But the actual supply-demand scenario for gold was bullish. And I remained bullish, and I advised people to continue with a bullish posture on gold, even when monetary policy shifted from those rate hikes to the rate cuts. And as I've always said, the rate cuts are deflationary. They remove income from the economy. It is not money printing, it is money unprinting. And these massive asset purchases, again, that is the removal of high quality assets from the global economy. It's a stripping out of income. Those things are not bullish for gold. But underlying that, you still had the basic fundamentals of supply and demand. You had limited mine supply. I talked about those acquisitions and those mergers 2 years ago when mining companies, the big mining companies, found it more cost effective to acquire new gold reserves through acquisitions or mergers than to actually mine the stuff. And they were saying at the time, when gold was like 11, in the mid 1100s to 1200s, they're saying these acquisitions are justify a price of gold at $1,400. They were absolutely right. We ran up to 1700. But, and in addition to the supply situation, one of the big factors were these official gold purchases by the Bank of Russia, the People's Bank of China. As far as I know, China is still in there, but Russia pulling back is a big deal. Now, I don't know if this changes the bullish fundamental picture for gold, but it certainly necessitates, I think, a pretty significant correction in the price to discount to reflect one of the biggest buyers in the world pulling out of the market. So we got out of our gold positions yesterday. I sent out another email this morning when we were still trading above 1600. We closed below 1600. I think we'll definitely see that 1450 level tested again. And actually, I really think we could see gold go down into the 1300s, maybe 1370, 1380. Most likely, the bullish fundamental picture is still in place, but it is less so with Russia out of the picture. Now, I know recently, and here we go again, and this is why I'm always basically a contrarian when I approach markets. I have never seen, I shouldn't say never, but it's been a while since I have seen so many bullish forecasts on gold. Goldman coming out just a few weeks ago telling everybody to buy gold. You've had all these stories about physical gold shortages. I mean, those stories are everywhere. So the sentiment right now is highly bullish. You have people talking about gold shortages. There's no supply. The CME is having problems because their warehouse, whatever they're stating in their warehouse, it's not really there. Those are just receipts. So, you know, all this bullish stuff. Meanwhile, Russia's pulling out. So gold is going down. All right, let me talk about the Fed announced today. Now, you know, we've had this conversation. I've had this conversation for a long time with the so-called dollar shortage. And last week or a week and a half ago, I said, you know what? Last week, actually, I did a video. I said, it's real. I saw the swap lines. Because remember, those liquidity swaps that the Fed has, those Forex swaps, throughout this whole entire last 2 years when people were talking about dollar shortage, they were minuscule. Nothing really. By central bank standards, you were talking about what? Sometimes 40 million, sometimes 50 million. And I told you that back in 2008, when there was a real dollar shortage, those swap lines ran up to almost 600 billion. So last week, we finally saw a big increase in those swap lines. They went up in 1 week, 206 billion. Boom, just like that. So I figured, and I think I said this, that's the Fed stopped everybody out. Stopped everybody out. Here's your dollars. Boom. The shortage was alleviated. We saw the dollar index come down from almost 103 into the 98 handle. Then it started to creep back up again. Yesterday and today started to creep back up again. The Fed comes out today and it says we are now going to engage in repos, right? Repurchase agreements to supply dollars. And I was like, huh? What's the reason for that? You got these swap lines that have been in existence for years and they're used routinely, central bank to central bank. What's with the repos? Because with the repos, the counterparty, whoever the Fed is dealing with, they have to put up treasuries as collateral. And the Forex swap lines that the Fed uses, that's not the case. The Fed engages in those with other central banks. And now I found out the reason for the repos. Because there's basically like 2 tiers of central banks that the Fed deals with. Tier number 1 are the central banks that the Fed considers peers. You're talking about the ECB, you're talking about the Bank of Japan, you're talking about the Bank of England, you're talking about the Bank of Canada. The Fed will engage in those swap lines with those banks on an open-ended, unlimited basis. They don't have to pledge anything, and as a matter of fact, even if the exchange rate deviates wildly from the agreed upon swap rate, the Fed will not issue a margin call. It just feels, hey, those other central banks, they're peers to us. We have no problem dealing with them. They're good and we'll keep it that way. However, these new repos are intended for central banks that the Fed considers more like just commercial banks. So these are smaller, lesser tier central banks. I don't know the names of them. It wasn't provided. But now I understand why the repo. But this is another, another remedy for the so-called dollar shortage. Now the Fed is expanding dollar availability to systems, banking systems that otherwise did not have this kind of access to the Fed. Now it comes with a little bit of a catch. These other central banks have to pledge treasuries, have to put up their treasuries as collateral, and there's not a lot of treasuries out there anymore because the Fed's been buying all of them up. But the repos should address the what is left over as the lingering dollar shortage at this point. We'll have to see. I mean, when this was announced today, the dollar was actually strong, and then it gave up most of its gains. So we'll see what happens. So there you go. Gold, Russia is pulling out. That's bearish. We're going to see a big correction in the market, and the Fed expanding its dollar provisions to other central banks via the repo mechanism. See everybody tomorrow. Stay well. Bye-bye.